So we're continuing with adjustments in the final accounts, part 2. So far, we have looked at capital and revenue expenditure. In this video, we're going to discuss depreciation. So before we can go into details of what depreciation is, first we have to know that when a fixed asset is sold or disposed of, it is necessary to remove it from the books by accounting for. Okay, so you have this car which is for the business. It's a fixed asset. It's not meant for resale. Now at some point you think, okay, for one reason or the other, this car is not needed, so we need to sell it. So when it's about to be sold, since it has been used, there are certain factors that you must consider that must be accounted for, and includes the original cost of the asset. How much did you buy it? Number 2, accumulated depreciation. How much has it depreciated in value? How much has its value reduced? Okay. Also, sale proceeds. When we sell it, where are we going to record the money? And any resulting profit or loss. So what causes depreciation? What causes a fixed asset to lose value or to have its value reduced? Okay, when, for example, your vehicle was 90,000, then maybe after some years you may end up selling it at 40,000. Why? Okay, so first is physical deterioration. So physical deterioration is basically wear and tear, erosion, rust, rot, decay. As you are using the vehicle, it is exposed to water. It of course it's a machine, so parts are moving past each other, friction. So at the end of the day, as you are using it, it becomes a bit not damaged, but worn out, so to say, or it won't be as good as it used to be when it was bought. Okay, so as you're using it, it will be reducing in value because of it is being exposed to the elements such as water, also the fact that it's working, so parts are getting used up. Okay, also there may be, because of economic factors such as obsolescence, which is becoming out of date due to technological advancements. For example, if your company was in 2013, 2012 maybe, yeah, so in 2012 we had smartphones. No, they were not smartphones. There were some phones which were very famous: Motorola, what and what, Nokia, what and what. I've forgotten the model numbers. So you bought these as fixed assets so that your workers can be using to communicate with clients, right? Now, it's 2020. They are still in good conditions. They haven't have had physical deterioration, okay? But there's need for smartphones now so that they can be accessing internet and all. So it means those phones have become obsolete, okay? So they have to be disposed of, okay? So they depreciate in value because the technology is no longer in fashion, so to say. Also, there's an issue of inadequacy, that is, asset no longer suitable due to business growth or changes. The same example that I gave, maybe the phone needs you to talk with clients on WhatsApp, but it is unable to do that. The other reason is time. Even unused assets can lose value over time. Imagine if the same phones you had bought in 2012, some of them you had kept to use them in future. Then in 2020, the technology is no longer being supported, so it will become useless. So now we look at methods of calculating depreciation charges. Okay, so what are depreciation charges? We're talking about, you buy this phone at 1,000, then after using it, or maybe after change of technology, people don't like it. A few people don't like it. I mean, a few people like it, but most people don't like it. Okay, so maybe because you cannot easily sell it, so you have to put it at 5,000, at 500. So the depreciation charge, the amount you're going to lose due to depreciation, is the difference between the 1,000 and the 500. 1,000 minus 500, which is of course 500. So that value which you lose because of depreciation is what depreciation charge is. So we're going to learn how to calculate it. So there are basically two methods. The first one is called straight line method. So this one uses this formula, and it is of course measured in this case per year. So its annual depreciation is equal to the cost. The cost is the amount of money you spend to get that item minus residual value. Okay, the residual value is simply the scrap value or salvage value. Okay, it's the estimated amount that a fixed asset will be worth at the end of its useful life. So you look at this, then you can estimate that maybe this item, this phone, will be used for 2 years. After 2 years, the battery will become very bad. So maybe even though I've bought it at 1,000, people can buy it at 600. Okay, so the 600 that you are estimating is the residual value. Okay, then the 1,000 is the cost, then the residual value is the 600. Then you divide by the useful life. The useful life is the amount of time you expect to use that asset. Okay, so in the example that I gave of a phone that was bought at 1,000 and sold at 600, and it is expected to, sorry, it was bought at 1,000 and it is expected to be sold at 600 after 2 years. The useful life is 2 years. So here's an example. A vehicle costs 500,000, has a residual value of 20,000 and a useful life of 4 years, meaning that this vehicle, after 4 years, people would be willing to pay for it 20,000. So depreciation is the cost 500,000 minus the residual value 20,000 divided by 4, which gives us 120,000 per annum. Meaning that if you buy it at 500,000, after 1 year it will lose this value. Okay, it will become 380,000. Okay, after another year it will lose this value. So from that 380 you have to subtract 120. So each year it will be losing a value of 120,000. Next, we look at the second method called reducing balance method. So the formula here is depreciation is equal to fixed percent times net book value at start of the year. Okay, so this one, the reducing balance method, there is a fixed percentage which you always have to multiply with the net book value of at the start of each and every year. Okay, so that's how it works. To understand this, maybe we look at an example. So here is an asset that costs 150,000. The depreciation rate is at 20%. So using the reducing balance method, let's see how it's going to depreciate. So in the first year, 20% of 150,000, which you get on a calculator just by punching 20% times 150,000, or 20 over 100 times 150,000, you get 30,000. So it means after 1 year, it loses 30,000, meaning that the following year, it will have a value of 150 minus 30, which is 120. Okay, it was 150, it has lost 30, so it's 120. So its new net book value is 120,000. The second year, we're going to do same 20% of the new net book value, 120,000, which is going to be 24,000. Okay, then the following year, so its new net book value will be 120,000 minus 24,000, which will be 96,000. So the following year, we're going to have 20% of 96,000, which is 19,200. Okay, so its new net book value at the end of year 3 is going to be this minus this. Okay, so this is the reducing balance method. Okay, so now how do we record the activities of depreciation? So there is a special account which is called provision for depreciation, or depreciation provision account, and also it is closely tied to another account which is focused on assets bought or sold, which is simply the machinery account. So we're going to take a look at these two. Okay, so the double entry for depreciation is you debit the profit and loss account and you credit the accumulated provision for depreciation account. Okay, so this is a special book. Okay, so when an asset has lost value, it's more like we have spent as a business. So that money that is spent in form of depreciation, we credit this account as if this account is the one that is giving away the value. Okay, then the profit and loss account will receive it as a loss. Okay, so remember, expenses, we debit them. So it's going, a depreciation is more like a loss, so it's going to be recorded in the profit and loss account. Here's an example. Seychelles Limited purchased on the 1st of January 2004. I was in grade 5 by then. Yeah, so the company purchased a motor vehicle at 25,000. Also, the company the following year purchased a second motor vehicle at 30,000. Depreciation is calculated at 20% using reducing balance method. So what do they want us to do? Calculate the depreciation, recording the motor vehicle account and provision for depreciation account for 3 years. So 2004 something happened, 5 something happened, so we have to include 6. Okay, where there's no information, but we can assume that no vehicles bought and that the assets kept on depreciating at 20%. Okay, so here is the calculation for depreciation. This is not the general format. You can calculate in whatever way you want. What is important is the concept. So here there is, we're starting from 2004, 5 up to 6. Then here is information. So here we have motor vehicle 1, motor vehicle 2. So in 2004, we 1st January 2004, we bought a vehicle, right? So by the end of 2004, this vehicle had depreciated by 20%. The vehicle was 25,000. So 20% of 25,000, when you get a calculator, you do 20 over 100 times 25,000, or 20% times 25,000, or 20 divided by 100 times 25,000, you get 5,000. So this is the amount that has depreciated, or simply this is how the motor vehicle has lost value by 5,000, meaning that the new value of the motor vehicle is 25,000 minus 5,000, 20,000. This is the new value of the motor vehicle. Motor vehicle 2 was not bought by then, so there's nothing to record. So we know that we have lost 5,000 in the vehicle through depreciation. Okay, then in 2005, there is also 20% of 20,000, 20% of 20,000. Okay, where is this 20,000 coming from? It is this 20,000 because in 2005, the value of our first motor vehicle is 20,000 now. So by the end of 2005, it will again lose by 20%. So 20% of 2,000 is 4,000. But again, at the beginning of 2005, we bought a vehicle, right, which was 30,000. So 20% of 30,000 is 6,000, meaning that in 2005, we have lost the 4,000 from this vehicle and the 6,000 from this vehicle. Total depreciation is 10,000 plus the one for the previous year, 2004. So this 10,000 plus 5,000, we record it as the accumulated, meaning that it is increasing. In 2004, we had 5,000. In 2005, we have 10,000. So 5,000 plus 10,000, 15,000. Then the new value or the remaining values of our motor vehicles, in 2004 it was 20,000, but it has lost value by 4,000. So it's now 16,000. Well, for the second motor vehicle, we just bought it at the beginning of 2005 and it was 30,000, but it has lost a value of 6,000. So 30 minus 6 is 24,000. Okay, so in short, 20 minus 4,000, 16,000, 30 minus 6, 24,000. Okay, we go to the last year, that is 2006. So the first motor vehicle, the current value as of 1st January 2006 is 16,000. By the end of 2006, it will lose value by 20%. 20% of 6,000 of 16,000 is 3,200. Okay, so now 16,000 minus 3,200, it's going to be 12,800 as the remaining value of the first motor vehicle. Okay, then for the second motor vehicle, its value is 24,000, right? So it also lose value by 20% of 24,000, which is 4,800. Okay, so 24,000 minus 4,800, it's going to be 19,200. Okay, so the total depreciation is, the previous year we had 15,000. So 15,000, we have to add these two. Okay, so when we add these two, we're going to get the total of 23,000, meaning that in 3 years, we have lost 23,000 from those motor vehicles. So we've done the calculation for depreciation. So the accumulated figures, we're going to take them to their respective accounts, which is provision for depreciation. Then also the two vehicles we bought, we're going to record them in the motor vehicle account. Okay. So next is the motor vehicle account. So this is nothing new. This is something we've been doing. Okay. So 1st January 2004, let's assume we bought by bank. You can't buy a vehicle by cash. Yeah, but anyway, we bought by bank. So bank gave away 25,000 for the first vehicle, right? So at the end of that year, the balance carried down is 25,000. So the total is 25,000 and brought down is 25,000. The following year, 2005, we bought another vehicle at 30,000. So cash gave away 30,000 and the motor vehicle received 30,000. So 25,000 plus 30,000, we're going to have 55,000. This is balance carried down, balance brought down. Okay, so this ends the motor vehicle account. Nothing new, what we were doing before. Okay, so next we go now to provision for depreciation account. So the provision for depreciation account is going to be like this. Okay, so at the end of 2004, there was depreciation from the first vehicle, which was 5,000. Remember, the first vehicle was 25,000 and the depreciation was at 20%. 20% times 25,000, it is just 5,000. Okay, so the total is 5,000 carried down, the balance is here. Okay, and of course, since we debit the profit or loss account, so the details is going to be profit or loss account. Then in the profit or loss account, we're going to have provision for depreciation. Okay, and the money is going to be on the debit side, so to say. Okay, so the following year, at the end of the following year, we have two vehicles together giving us 10,000. Okay, if you go back to the calculation for depreciation, in the second year, the total for both vehicles was 10,000. So this 10,000, we record it, we add it to this, we get the total 15,000, and these are the balances. Okay, then the final year, where we did not buy any vehicle, the total depreciation was 8,000. So 15,000 plus 8,000, 23,000 is the total, and the balances. So that's how to do provision for depreciation. So this marks the end of the lesson. See you in the next